Right, let's get straight into it. Welcome to today's explainer of the latest institutional macro briefings. It is August 14th, 2026, and today we're putting on our analyst hats. We're looking at the market strictly through the lens of a Tier 1 investment bank research desk. Our goal here? To completely strip away the emotional noise and surgically dissect the actual capital flows, the macro shocks, and the structural inflection points that are dominating asset pricing right now. We're not going to waste time on surface-level headlines. Instead, we're diving deep into the underlying mechanics that are literally dictating portfolio performance today. Here is our roadmap for the briefing. We're moving systematically through 5 core pillars. We'll start with the sudden macro shock hitting the consumer, then uncover the hidden liquidity mechanics in the banking system, explore equity microstructure, specifically the massive gravity of AI capital, look at some alternative signals from sovereign actors, and finally, synthesize the whole shebang into a strict, actionable, strategic plan. Starting with Pillar 1, macro shock, we are looking at an undeniable, fundamental contraction in our macroeconomic foundations. I really want you to consider the magnitude of this miss. July U.S. retail sales dropped by negative 0.6%. Think about that for a second. This is absolutely not a rounding error. It's the steepest decline we've seen since May of 2025. And it completely obliterates the consensus estimate, which was looking for a 0.1% gain. Remember, the American consumer drives roughly 2/3 of all U.S. economic growth. And right now, that consumer is officially hitting a brick wall. Now, you might be wondering, is this retail drop just a one-off blip? Well, when we cross-verify this data with a broader economy, the answer is a hard no. This is structural deterioration. Look at the labor market. July non-farm payrolls outright contracted by 23,000 jobs. The market was expecting an 83,000 gain. You add in an 8% collapse in consumer sentiment and a rapidly cooling CPI, and you can see why the market is violently repricing reality. The probability of a September Fed rate hike just completely cratered, from 70% down to 31%. The entire narrative has shifted on a dime. We're no longer trading on inflation fears, we have moved squarely into growth fears.
That brings us to Pillar 2, liquidity mechanics. Because as the real economy cools, we have to look under the hood at the immediate threats to the actual plumbing of the financial system.
We are currently staring down an impending liquidity vacuum. This week alone, roughly $130 billion is scheduled to be drained directly from the overnight funding market. Why? Because of massive Treasury settlements hitting on Tuesday, Thursday, and Friday. Every single time the government issues this debt, capital gets sucked right out of the institutional system to pay for it. In practice, this acts as instantaneous, brutal quantitative tightening. To really grasp the structural stress this creates, just track the relentless, exponential surge in electronic treasury trading volumes on platforms like TradeWeb. The sheer mountain of government debt being transacted every single day right now is historically unprecedented. It requires an immense amount of balance sheet capacity from the market just to process the paper. And honestly, here is where the system is starting to fracture. Look at this massive post-crisis divergence. The explosive growth of outstanding treasuries has fundamentally outpaced the growth of primary dealer bank capital. We haven't seen a structural break in banking capacity quite like this since the lead-up to 2008. The supply of treasuries is overwhelming the system. The market is practically choking on paper, and the dealers simply have limited capital to step in and grease the wheels. Which leads to the stark reality of our liquidity situation today. The Fed's reverse repo facility, which has basically been our shock absorber for excess liquidity, is nearly exhausted. It plummeted from $214 billion last month to just $80 billion today. So what does this actually mean for portfolio managers? It means the buffer is gone. Any future increases in the Treasury General Account are going to directly cannibalize institutional banking reserves. The liquidity cushion has deflated. Moving on to Pillar 3, equity microstructure. Given the consumer decay and the impending liquidity drain we just dissected, you're probably asking, why on earth is the broader stock market holding up so well? The answer is that capital is ruthlessly concentrating in artificial intelligence, completely divorcing itself from the traditional business cycle. To understand this, we have to separate the media noise from the institutional signal. The headlines are screaming about a supposed executive exodus and C-suite volatility over at OpenAI. But the smart money, they're looking at the signal. OpenAI just hit an unbelievable $40 billion annualized revenue run rate, fueled by a 32% monthly surge in enterprise business customers. This isn't just hype anymore. Enterprise adoption of generative AI is accelerating so violently that it's literally breaking traditional valuation models. This massive revenue generation is culminating in some wildly aggressive systemic financial engineering. Right now, Goldman Sachs is actively mobilizing investors for NVIDIA's $500 billion financing initiative. And guys, this isn't just a standard debt raise. They are effectively engineering AI compute infrastructure into a brand new tradable asset class. By packaging data center hardware into instruments that trade a lot like asset-backed securities, AI compute itself is becoming revenue-generating collateral. It's a real game changer for how we price technology. This engineered capital flow perfectly explains the incredibly unified consensus among the Tier 1 banks right now. Despite the consumer recession we talked about earlier, JP Morgan, Goldman Sachs, and Morgan Stanley are all locking in a year-end S&P 500 target of 8,000. Why? It is driven strictly by hyperscaler AI spending and artificially fortified EPS estimates. We are literally trading in a bifurcated reality, an unstoppable AI factory boom on one side and a rapidly decaying traditional economy on the other. Let's pivot to Pillar 4, alternative signals. When traditional equities detach this far from macroeconomic reality, we have to look for clues in the commodity markets and watch what sovereign actors are doing. Just look at this number. 288.9 tons. The scale of accumulation here is absolutely staggering. In Q2 of 2026, central banks purchased a record 288.9 tons of physical gold. For my money, this is arguably the most critical structural data point for real assets we are going to discuss today. Let's break down why that matters. That 288.9 tons represents a massive 62% year-over-year increase. But the real context is when they bought it. Sovereigns accumulated this during the steepest price drop since 2013. While retail investors were totally panicking, literally dumping 45 tons out of ETFs, nations like Poland and China were quietly backing up the truck. They don't day trade gold, they treat it as a structural reserve. By entirely absorbing the retail panic, these sovereign buyers have built an impenetrable price floor, launching gold up 10% this month to its current $4,330 level. Which brings us finally to Pillar 5, the strategic action plan. We've mapped out the macro decay, the impending liquidity crunch, the extreme AI concentration, and this massive sovereign gold buying. So what is the institutional move? How do you actually reallocate based on this data? Here is the strict, actionable verdict for fund managers today. Your posture needs to be aggressively bifurcated. Scenario A, the growth engine, means we are heavily overweighting AI infrastructure and those new associated debt vehicles. We are also staying overweight on physical gold, riding those sovereign coattails to a $4,900 target. But for Scenario B, the macro decay, it is time to actively underweight consumer discretionary equities in response to that verified retail collapse. And crucially, make sure you are actively hedging against short-term liquidity crunches around those massive treasury settlement dates we discussed. I want to leave you with this final paradox to chew on as you adjust your models today. If the real economy, which is driven by a completely tapped-out consumer, is undeniably contracting, how long can this isolated, multi-billion-dollar AI build-out independently sustain the S&P 500 at record valuations of 8,000? It's basically a high-stakes race between the reality of Main Street and the engineered capital of Wall Street. And that, my friends, is your macro environment for today. Thanks for joining this explainer, and stay sharp out there.